Something important just happened in the GTA housing market. And if you only looked at the sales or the average price, you probably missed it. Sales actually fell slightly in July, and the average price fell again. But beneath those headline numbers, the market got noticeably tighter. And that could be one of the earliest, clearest signs yet that the GTA housing market is starting to find its bottom. I'm Steve Bucciol, co-team leader of the Property Boys at Royal LePage Signature Realty. Let's break down what actually happened in July, because the headline numbers don't tell you the whole story. Let's start with sales. There were approximately 6,000 home sales across the GTA in July. That's down just about 1% from last year, so basically flat. And yes, that ended our consecutive months of where sales have been increasing year over year. But here's the important part. Year to date, GTA sales are still up 1.1%. So demand didn't suddenly disappear. The bigger change happened on the other side of the equation, and that's supply. New listings fell almost 18% from last July. Only approximately 14,500 properties came onto the market. That's now 7 consecutive months where new listings have declined year over year. And new listings actually fell below the 10-year average. Active listings also dropped 12% from last year. Now, there are still a lot of homes available. Active listings remain 38% above their 10-year average. So I'm definitely not saying we've suddenly entered into a seller's market, but the direction here matters. For most of the last couple of years, inventory was always building. Now it's starting to be absorbed, and that's changing the balance of power. Here's probably the most important number that happened in July. It's the sales to new listings ratio that jumped to 41%. And last July, it was only 34%. What does the sales to new listing ratio actually mean? It's actually pretty simple. It compares the number of homes being sold with the number of new properties coming onto the market. So very simply, 100 homes are listed and 41 homes sold. Your sales to new listing ratio is roughly 41%. The higher that percentage gets, the more demand is keeping pace with new supply. The lower it gets, the faster inventory tends to build, because new properties are coming onto the market faster than buyers are able to absorb them. And that's why the move from 34% to 41% matters. It's not necessarily because buyers are suddenly coming and flooding back into the market. Remember, sales were basically flat. The big change here was that far fewer sellers listed their homes. So buyers are now absorbing a much larger percentage of the new inventory coming onto the market. And according to this new level, the 40% represents the lower boundary of a balanced market. So at 41%, the GTA has jumped back into balanced territory. But then there's a second number I always like to look at alongside the sales to new listing ratio, and that's months of supply. Months of supply dropped from 4.9 months last July to 4.4 months today. So what does that actually mean? Months of supply is a measurement of how long it would theoretically take to sell the inventory currently on the market at the current pace of sales, assuming that no new listings came onto the market. So if we have 4.4 months of supply, technically it would take you approximately 4.4 months to sell at the current pace of sales. The lower that number gets, generally the tighter, more competitive the market becomes. If month supply is rising, inventory building is building faster than buyers are absorbing it. That usually gives buyers more choice, more time, and more negotiating leverage. But when months of supply starts falling, the opposite begins to happen. Inventory is being absorbed, buyers have fewer choices, and eventually, if it's far enough, sellers can start gaining some of their negotiating leverage back. And that's why I like to look at these two numbers together. The sales to new listings ratio tells us what's happening with the flow of new inventory coming onto the market, and months of supply tells us about the overall inventory that's already sitting on the market relative to the pace of sales. And right now, they're both moving in the same direction. The sales to new listing ratio has risen from 34% to 41%, and months of supply has fallen from 4.9 to 4.4 months. So new inventory is coming back onto the market more slowly, while the inventory that's already there is gradually being absorbed. That's the tightening I'm talking about. It doesn't mean bidding wars are everywhere now. And it doesn't mean we've suddenly entered into a strong seller's market, but it could mean buyers are gradually starting to lose some of the negotiating leverage they once enjoyed. Now let's talk about prices, because this is where the numbers gets really interesting. The average GTA selling price was about 1.004 million in July. That's down 4.5% from last year. And that's now 18 consecutive months where the average price has declined year over year. That sounds very bearish, I know, but here's the catch. The average price is simply the average price of all homes that happen to sell that month. So it can be heavily influenced by what types of properties are selling. Think about it this way. If one month you have a whole bunch of $2 million detached homes selling, and the next month you have more $600,000 condo selling, the average price is inevitably going to fall. But that doesn't necessarily mean that the value of an individual house or condo fell by the same amount. And that's why I always like to pay attention to the benchmark price. The benchmark is designed to track the value of a typical home with similar characteristics over time. So it helps remove some of the distortion caused by the changes in the mix of properties being sold. And here's what's interesting. While the average price was down year over year, the benchmark price actually edged higher month over month in July. Now that's important. It doesn't mean home prices are suddenly taking off, but it does suggest that the underlying market may be starting to stabilize. So don't just look at the headline average price. Sometimes what's happening underneath that number tells you a very different story. And condos might be the best example of that. We've spent the last couple of years talking about massive condo inventory, but that inventory is starting to shrink. Active condo listings dropped 15% year over year. New condo listings fell 18%. And that's now the 11th consecutive month that they've been declining. Condo months of supply also dropped from 6.3 months last year to 5.3 months today. And now that you know what months of supply means, the number becomes a lot more significant. We're not just saying there are fewer condos listed. We're saying that relative to the new current pace of condo sales, it would now take roughly 1 month left to absorb the available inventory that it did a year ago. And condo prices, they were down only about 2% year over year in July, compared with a 9% decline just 1 month earlier. They also edged higher month over month. Central Toronto was particularly strong. Condo sales increased 7% year over year, prices were down only 1%, and months of supply came in at 4.8 months. I'm not saying the condo market is completely recovered, but we're definitely seeing some early signs of stabilization. And there's another really interesting trend buried in the July numbers. Affordability is driving this market. Condos under $500,000 accounted for 38% of all condo sales in July. A year ago, it was only 26%. Sales below $500,000 jumped 45%. And almost 2/3 of all condo sales were below $600,000. We're seeing the same thing with houses. Every low-rise price category below $900,000 saw sales increase year over year. Every category $900,000 and above have declined. That's a pretty clear message from buyers. They're willing to buy, but the price has to make sense to them. So has the GTA housing market officially hit a bottom? I'm definitely not ready to say that yet, but the evidence is getting stronger. Supply is falling, months of inventory are declining, sales to new listings ratio is improving, the benchmark price is beginning to edge higher, and condos, one of the weakest parts of the real estate market, are showing early signs of stabilization. Now, there's still a major wildcard. Prices remain roughly 25% below the early 2022 peak, and there may be homeowners waiting on the sidelines who will list once prices improve. If that inventory comes back onto the market, we could see a slowdown in the recovery. But right now, July's numbers tell me something has clearly changed. We're no longer watching inventory pile up faster and faster. We're watching it slowly get absorbed. And that's what I'd like to be paying attention to as we head into the fall market. Because if you're waiting for prices to tell you that the market has changed, you may be watching the wrong indicator. Watch supply, because right now, that's where the real story is. I'm Steve Bucciol with the Property Boys at Royal LeSpage Signature Realty. If you want more GTA real estate updates without all the noise, subscribe to the channel, and I'll see you in the next one.